Welcome to the lecture on reserve funds and property and casualty insurance. So, we talked about the life insurance policies in the earlier lecture, and we will talk about the reserve fund and the terminal reserve fund basically. So, the reserve fund in the insurance, that is insurance reserve fund, it is a difference between the accumulated value of insurance premium and the accumulated cost of the insurance. So, this basically this is what you have the accumulated value of the insurance premium and also the cost of insurance, because you are giving the you have to give the penalty, you have to pay the benefits. So, basically its difference will be the reserve fund. What we have seen earlier when we talked about the level premium calculation. So, in that case what we saw that you are paying initially the excess of the premium, and basically that excess which you are paying, now that gets accumulated, and also you are earning the interest on that. So, you are basically increasing the the amount as the time increases, but in the later years certainly the natural premium amount is larger. So, in that case that will be taking into account the lags which is there in the later years, and also to pay the due death claims and also other obligations when the level premium accumulations lag behind basically the liabilities. So, in the later years basically your whenever you have to give the liabilities, you have to pay the liabilities, that time basically it will be used to pay that. Now, the amount of reserve, interest, claims and obligations, all these things. So, actually they are calculated in every year, and that of the policy term, and the remaining fund which we calculate. So, that is known as the reserve fund, and when we are dividing it using by the number of survivors, then we call it as the terminal reserve fund. So, for getting the terminal reserve fund that we have to divide the reserve fund by the number of survivors. So, when we talk about the terminal reserve fund, so in that basically it will be talking about the maximum amount a policy holder will be getting. So, suppose if he goes for the discontinuation of the policy at the year's end, or if he wants to have a loan, then how much loan he will be getting. So, that also will be depending upon the terminal reserve fund. So, that is how it is calculated. So, we will see that how these so there are basically two ways by which these terminal reserve funds are calculated. One is retrospective method and another is the prospective method. So, prospective method. So, when we talk about the retrospective method, now that can be understood by referring to the table, and in that basically in every year you are going to calculate the you have to calculate these reserve funds. So, how we do it basically that we can see. Now, if suppose a 15-year term policy is of 1 lakh is issued to a 50-year-old person. So, in that case how you are going to calculate these terminal reserve funds. So, for that basically you will have the policy year. So, policy year will be from 1 to 15. So, that way that value will be changing. So, this will be it will be going like 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, like that it will go. Then next we will be having the age. So, age we have we talked about the 1 lakh policy for a 50-year-old old person, his age is 50. So, we will start from 50, then 51, 52, 53, 54, 55 and 56, 57, like that it will go. So, it will be going for the 15 years. Then what you do is you have to find the Lx. So, Lx you will be you can get it from the the mortality table, and you know that how these mortality tables are seen. So, if you see the mortality table, so if in 50 years this Lx is this is 91,526, and then from 51 onwards it is 9986, 9402 or so. So, that way these values will be coming in the place of Lx. So, it will be 91,526, 9986, then you have 9402, 89 087 and so. So, this way you can use it from the table, and then after you get these Lx from the table, you will be also getting the value of dx from the table. So, that also is there in the mortality table. So, from the table you will be taking the dx values. So, it will be 540, suppose 584, 631, then 684 or so. So, that way the dx will also be changing. So, its values are in this column. Now, so total premium, suppose total premium which is calculated at the start of year. So, you know that you are going. So, we have seen that when we calculated for the level premium for the insurance, then for level premium we know that we had calculated this to be 986 0.25. So, the total premium at start of year will be the Lx multiplied by the premium amount. So, it will be basically, so if we take it as this is as 1, this is as 2, this as 3, this as 4 and this as 5. So, 5 will be nothing but Lx and multiplied by 986.25. So, it will be 3. So, it will be equal to 3 into 986.25. 986.25 we had calculated, it was the level premium which we calculated. So, because level premium is the fixed amount which is represented by the straight line, horizontal straight line, and your natural premium will be going initially it is below, and then later on it as the age increases it will be going on increasing. So, that 986.25 will be multiplied. So, it will be the total premium at the start of the year. So, your reserve at the start of year will be same. So, if you multiply this Lx with 986.25, in that case you get 90, 268, 432 say you are getting. So, if you multiply this with 986.25, you are going to get something like this. So, similarly you are further going to multiply 986 multiplied by 986.25. So, that way you will be having 89, 735, 852, similarly 89, 159, 876, like that. So, it will go. Then if you want to find, so reserve at the start of the year. Now, reserve at the start of the year will be your 90, 268 and 432. Now, before so after that, once you have the reserve at the start of the year, then you will be finding the interest earned. So, on reserve. So, that is interest earned. So, since we are taking at 5%, so what you will do this, so it will be 6. So, once you have reserve, on that you will be having the reserve. So, it will be nothing but 0.05 multiplied by this quantity whatever you have reserve. So, this interest will be there, and once you earn the interest, then next is the death claims. Now, this will be depending upon the number of deaths, and you are giving so face value of the policy is 1 lakh. So, you are paying 1 lakh. So, you for that you are multiplying this dx multiplied by 100. So, that will be dx into not 100, it is 100,000. So, that will be your death claim, and once you have the death claim, then now this is your this was your reserve fund, and on that you accrued the interest of 5% of this. So, it will be coming as 4513422, and death insurance will be 540 on, and on that basically you have 1 lakh. So, it will be this much. So, that will be the death claim. So, now the reserve at the end of the year will be your total reserve, that is your reserve was there at the year of beginning plus interest accrued, interest earned on that fund. So, that is your total reserve fund, and then you are subtracting the death claims. So, it will be basically so your reserve was 6 and interest earned is 7. So, total is 6 plus 7 and claim you are giving as 8. So, 6 plus 7 minus 8. So, this will be the reserve at the end of the year. Then this is the final reserve. So, so if you look at, if you have to add these two and then you have to subtract this amount in from this. So, that will be coming as 4781 854, and then if you are further finding the terminal reserve. So, if you try to find the terminal reserve, now for finding the terminal reserve, so this is 9. Now, terminal reserve is basically the reserve which you have at the end of the year divided by the number of policy holders. So, it will be 9 divided by 3. So, this is basically 10, and 10 will be equal to 9 divided by 3. So, if you divide it, you are going to get 445.58. So, basically you are using you are going to calculate these terminal reserve fund. So, you can fill once you know these values, you can fill, you can use the you can use the Excel sheet and you can calculate these values for the terminal reserve at any year or so. So, this method of retrospective method, so basically you are in this case you are calculations are made at the end of each year of the policy, and that is why you are going by looking backward to the beginning of the year. So, you are looking backward. So, that is why it is known as the retrospective method. Another method which is used is the prospective method, where you are looking forward, you are rather than looking backward, you are looking forward, and in that you are going to look for the future benefits and future liabilities of the policy, and based on that you are going to calculate these reserve funds. So, that is known as the prospective methods. Now, we are going to talk about the how much insurance we should buy. Now, so now what should be the how much insurance you should aim of buying. So, what we know by life insurance, so it is a protection for the survivors or beneficiaries in a policy to provide them with the ability to continue living their lives normally after losing a loved one. So, that is what the meaning of life insurance is here. you are thinking that you are going to provide, your survivors should be should have a protected life, this should have a definite standard of life. If the person is not here because of any reason, and in that case they should not suffer much. So basically you are survivors or beneficiaries for them, for their protection and for their livelihood. You normally go for insurance. Now how much insurance you should provide, that's very that's a question which is always there in the mind of the investor, that how much you should buy many a times. So the approach which is used for the for estimating the amount to buy in life insurance, so it will be depending basically on the so first is the sentiment. So this is highly subjective approach, and it will be depending upon the emotional emotional values, how much he places on his survivors, how much emotionally he is attached. So based on that, based on irrespective of the real needs, basically normally he will always be thinking more than the real needs of the family, and so he will be talking about he will be using his sentiments only to to help his survivor or the family. Next is the rationality. So there is a rational approach. He will have certain criteria based on which he is going to decide that what should be the amount for which he should go for the investment. So in that case he will be talking about the income, insured's income, and then he will be talking that how much, if he is not there, then what will be the requirement, how much what will be the needs of the survivors. So based on that he will be talking about he will be calculating these amounts. So basically under that you have again you have methods to approach, and the two methods, which is the one is the multiple method. So that is multiple earning method. So that is basically part of the rational approach. So in that what we do is we take certain multiple of so basically it will be depending upon the insured's income as a basis of the calculation. So he will say that it should be 5 or 10 times the final amount which will make the insurance so that will make the life of these his dependents easier. So based on that he will be calculating the insurance amount, so the amount for which he should get the insurance. So it will also be depending upon how much premium is there. So and also if suppose for example, suppose a 50-year person is there and he wants to have a 25-year term life insurance. So in that case and he will use the 5 times the annual income of 75,000. So he will go for 5 times 75,000, that is 3,75,000. Now his premium, so if you look at so that will be 3,75,000 divided by 1 lakh, so that is 3.75. and if you look at the table, so by referring to the table you can find the for the 1 lakh the annual premium is coming out to be 762. So multiplying by the 3 times or 3.75 times, there will be one premium amount calculated, that will be something like 2857. So, he should take a premium of 2800 something like that, and based on that he should take that much amount of insurance for which for his he should get the insurance, or he should get insured for the survivors. Next is the calculation of the needs. So, he will be talking upon he will be discussing about what will be basically the need of the person after his death. So, he will be taking into the main needs like child's insurance, or the family debt, and all that will be taken off, and based on that he will be calculating that for what amount he should do the insurance. So, for that normally he will have the calculation, the life insurance amount calculation, and that amount of calculation will be based on certain factors, and that will be calculated by a formula that will be amount of life insurance, that is LA. It will be PV multiplied by 0.75 YD, and then plus OT minus PV into G plus CI. So, that way he is going to calculate this life insurance amount. Now, this is something PV is the present value of. So, PV will be the present value of certain stream of future income by survivors. So, what is notion is that they will need at least 75% of the insured's disposable income, that is YD, and in his working years, and then it is basically assumed that 25% will be the share of the family income. So, that is why 25% is basically not taken into, and 75% is taken. Then the OT is basically the vector of needed expenses included but not limited to expenses like. So, there are different type of expenses, like there are many expenses after the death of the person, like you have the expenses. So, in that you can have, that is categorized as F, R, D and E. So, F is normally for the funeral and burial of the deceased. Then you have the readjustment expenses, that is R. Then D will be the debt expenses what he has, so that is to be paid, and E is basically the educational expenses. So, these are the different type of expenses, so that he needs to have, that is why it is added. So, 75% is 25% is said to be something like that the family will manage. So, 75% comes here, then these are the need expenses after his death, and then it will be subtracted. So, this amount PVG plus CI. So, this is the PVG is basically present value of the benefits which it will be getting. So, the government benefits, there are many benefits it will be getting because of the insurance he has taken, social schemes are there he has taken. So, for that these so the PVG will be the present value of the government present value of the of the future stream of government benefits. Social schemes and so that will be added, and also CI is the current insurance policies, because in that case he will be getting certain amount. So certainly that will be also be a part which will be subtracted from what is the need. So once you get that, then you add these two, and then you add these two and subtract. So whatever amount comes, basically that is genuinely an amount for which you should think of being insured. So that is how you calculate the amount for which you should go for the insurance. Now we are going to discuss about the property and casualty insurance. So as we know that apart from the personal insurance, you have also property and casualty insurance policies, which are covering both the property and the liability risks by the reimbursing the policyholder financial losses due to damage, destruction or loss of property owned or controlled by the policyholder. So in that case it also reimburses the property damage and bodily injuries maintained by others, but for which the policyholder is responsible. So that is known as the liability insurance. Now what we do normally when we talk about the reimbursement, so there are basically some principle based on which these reimbursements are made, and the first thing which we talk in such cases is that the financial losses which are going on, which have to so they have to be result of pure versus speculative type of risk. So you will not be having you will not be insuring, you will not be get the insurance where you have also some benefits expectation, like in the case of gambling, suppose you can lose but you can also gain. So that cannot be insured when you have the potential for both risk and loss. So when there is only potential for the loss, so and no potential for gain, so that is known as the pure so that is pure risk basically, and a speculative risk is that where you have potential for both gain and loss. So there is no chance of having that insurance. Then also the second principle is that the insurance will not pay more than the actual financial losses. So this is known as the principle of indemnity. So it will look at the actual financial loss and then only it will be paying. So the challenge is that how to assess basically what is the actual financial loss. So what we do is the insurance companies normally find the actual cash value so as opposed to the original cost. So they will be finding the actual cash value of the property. So in that what is done is it will be considering the depreciation of the property due to wear and market conditions, and it will be calculated by taking the depreciation effect away from the original cost, and that depreciation effect also will be depending upon the current age of the properties, so that is CA, and it is also life expectancy, what is the life expectancy of the product. So actual cost value, if you see, that is defined as the OC, that is original cost, minus CA, that is your current age of the property, and that is multiplied by OC by LE. So LE is the life expectancy. So if you take OC out, it will be 1 minus CA by LE. So if you try to define these terms, ACV is the actual cash value, OC is the original cost, then the CA is the current age of property, and LE is the life expectancy. So, once you have these data, then you can find the actual cost value. And if suppose you purchased an item few years ago for certain amount, and the life expectancy suppose is 9 years. So, you have seen that, and so in that if you want to have that how much there should be reimbursement to the policy holder, then in that case the value is suppose 1500, and current age is 4. So, you have purchased 4 years ago. So, current age is 4, life expectancy is suppose 9. So, you will be multiplying 1500 with 1 minus 4 by 9, that is 5 by 9. So, you will be getting certain amount, and that will be the actual cash value of the product. Now, we also calculate basically the replacement value, and replacement value is basically the original cost and the change in the original cost, and the original cost will be there. So, it is changes because of the many factors like inflation or so. So, based on that you can also calculate these replacement values. So, depending upon the inflation rate you can calculate the replacement values also, which will be used for the calculation of the insurance amounts. So, accordingly you have calculation of these parameters are there with the different formulas you can use, and you can calculate these property insurances in such cases. And normally you have also another type of insurance which is there in the case of the health insurance, and there also you have the reimbursement, and for that there are many things, other things also required like co-insurance percentage, and then you have the financial losses. So, and the deductibles, which are also the concept which are used for finding the reimbursement, health insurance reimbursement that is required in the case of health insurance. So, basically these parameters we must be acquainted with. So, to calculate the premiums or the benefits in the case of the insurances. Thank you very much.